In project finance, a major concern companies face is how their revenue will be distributed to pay expenses and obligations. To understand how this can be such an important issue, imagine someone throwing millions of dollars from a car window out onto a busy freeway. Severe congestion and chaos would result from people trying to gather as much money as they could, leading to major problems on the freeway. To prevent this kind of chaos in project financing, a method of distributing cash based upon prioritization of expenses should be used. This method is called the cash flow waterfall. Interestingly, this method of distribution is also observed in the predator-prey cycle of animal societies. For example, these principles are practiced among a pride of lions when it comes to distributing the food obtained from the hunt. After hunting, the head male will eat first, forcing females away. This is critical to preserving his strength in defense of the pride. Once the head male has finished eating, he leaves the remains for the females and cubs. Feeding the cubs is critical to ensure the survival of the species over time. The females perform most of the hunting, so they must be strong enough to capture the prey. After the lions have eaten, the hyenas will have their chance to eat. After the hyenas, the vultures get their turn. This predator-prey cycle is an example of prioritization based on the law of the jungle, where the strongest predators eat first as their needs must be met first. Another example of this in nature is a cascading waterfall such as Dark Hollow Falls near Skyline Drive, Virginia. In this waterfall, water descends into a series of rock basins. If there is a constant flow of water, the basins would be filled beginning with the top basin, and the excess water would fall into the next basin until one by one they are all filled. But what happens when there is a limited amount of water and all the basins cannot be filled? In the case of a cascading waterfall, the upper basins must fill first, so according to this prioritization, the last ones might not even get any water. Therefore, it is critical that the upper basins be the most important uses of the resources. Just like the flow of water in a cascading waterfall, revenue must be used for the most important expenses first, and money that is left over can be distributed to the least important expenses. These are simple examples of allocating the resources in nature. In financing of long-term infrastructure, industrial projects, and public services with a non-recourse or limited recourse financial structure, the project debt and equity used to finance the project are paid back from the revenue generated by the project. Changes in payment schedules can create serious problems. However, lack of sufficient financial resources sometimes makes such changes unavoidable. To mitigate these problems, the prioritization of payment for various expenses should be defined. The procedure to define the priorities and amount of payments is generally referred to as a cash flow waterfall. The cash flow waterfall is a valuable protection structure in a project financing and company finances because it requires that the most important needs or expenses are paid first. The following is a list of typical priorities for payment of project expenses, with the highest priority listed first and descending to the least important priority. payment of operating costs, including the operation and maintenance contract and taxes, fees and expenses due to the agent bank, security trustee, or other necessary institutions, interest on debts, any swaps or other hedging payments, debt repayments, payments to the debt service reserve account and other reserve accounts, distribution to investors, and cash sweep of remaining funds. Using this prioritization method, cash flow waterfall, funds are used in the first category until all expenses have been paid. The remaining revenue is moved down to the second category in prioritization until all expenses have been paid. This continues until all categories are paid or there are insufficient funds to complete payments for a particular category. For example, it follows that if there is insufficient cash to pay the first 5 items, no cash is distributed to the investors. To understand how this particular prioritization of expenses is valid, consider the description of expenses involved in category. Operating costs include all cash flows related directly to expenses reported on the income statements, such as salaries, wages, income taxes, necessary services, and interest on liabilities. Thus, operating costs are the most important expense because work on the project would quickly stop if the expenses are not paid. People will not continue to work for a company or a project without prompt payment. Thus, this category has the highest priority of all. Prompt payment of expenses to the agent bank is critical because the bank authorizes loans which can be utilized when there is a cash flow shortage. If these expenses are not paid, the agent bank is less likely to be helpful in such circumstances. The interest of debt is used to meet the expenses of the SPV, to begin with those payable to external agencies and thereafter to pay interest to the various classes of investors. Debt repayment is used to pay principal of the various classes of investors. Cash is paid out of the cascade as necessary into various reserve accounts, which are under lenders' controls like the other project accounts. These serve to protect the project company's liquidity should there be a temporary shortage of revenue or increase in operating expenses, build up funds for particular purposes such as maintenance, or segregate special funds such as insurance proceeds. The investors come at the bottom of the cash flow cascade. Once operating costs and all the lenders' repayments and reserve account requirements have been met, the principal distributions to investors can be made. If the project company cannot immediately pay these amounts over the investors, they are paid into a shareholder distribution account in the name of the project company. But it is seldom quite as simple as seeing if there is any cash left over and paying it to the investors. There are other hurdles to jump. The project company obviously has to demonstrate that sufficient cash will remain or be regenerated in the future to repay debt after the distributions have been made. This is dealt with the establishing dividend stop or lockup ratios. In some projects, a cash sweep may apply. After an agreed-upon level of distribution to the investors, the balance of the cash flow is used to prepay the debt or split between prepayment and a further distribution to the investors. Thus, if the project performs according to the agreed base case, the investors will receive the base case return, but cash flow from the project above this level is split between investors and debt repayment. A cash sweep is also very useful as part of a package of measures dealing with problems that lenders might otherwise have the total length of the financing, or because they are concerned about the tail risk. In such cases, most or all of the cash flow generated after debt services is not distributed to the investors, but is used for debt prepayment or placed in a reserve account. Thus, it is easy to see how this system of prioritization is particularly relevant for project financing. The priority of these categories reflect basic requirements that the company would face to stay in business and keep the project going. If revenue were distributed to lower priority categories instead, then it is reasonable to conclude that the project would be harmed as salaries or taxes might not be completely paid. This is only one scenario, but it demonstrates the importance of using this cash flow waterfall method to establish how revenues will be used.